Tesla stock yet again today had another massive green day, up over 3% and breaking above $260 per share, which was Tesla's level of resistance. So what is coming next for Tesla stock and what do you need to know as an investor? We will cover that, but there is also growing concerns from big money on Wall Street that a larger correction could be coming soon, including strategists, which you will hear from, and Mike Wilson, that is also calling for a 10% correction, among many others. This is a pretty dramatic flip in just the last couple of days, especially as you are gearing up for Q2 earnings that officially start this Friday with your major banks that will report. And this is what that lineup looks like. You have Pepsi, Delta, Conagra, and Bank 7 that report Thursday morning, WD-40, and some select names that report as well today and after hours and tomorrow. But the big event is JP Morgan, Wells Fargo, Citi, and BNY Mellon that report Friday pre-market. And this could give us a heads up of what to expect for the rest of earnings season. Now, if you're curious why stocks just keep going higher and have been going higher for about a year now, that's because forward 12-month earnings expectations are just continuously going higher as well. Specifically from December of 2023 until now, EPS estimates have went from about $243 or so of EPS for forward 12 months up to where you are today at about $259 for expected EPS over the next 12 months. That is a massive increase, and as you can see here, it just keeps going higher, whereas when you look at something like 2022, that explains why the year was so rough, is because expectations continue to fall for earnings. Now, I would argue with expectations this high, markets are expecting over 11% EPS growth for the S&P 500 this year and about 15% for next year. Very historically abnormal to expect this strong of growth, especially late cycle with the Fed funds rate this high as the economy is worsening. I would make the argument that earnings expectations are too high. I would make the argument if we do see a broader market correction, it's probably because earnings expectations are too high and you get a little bit of a disappointment this earnings season. There is also what I would call three pillars of a correction, and we'll speak on that in just a moment. But first, Tesla stock. Tesla stock is over $260 per share today and just continues to march higher, marking 9 straight green days in a row. If we do get some weakness in the broader markets, don't be surprised if Tesla does sell down a little bit. But with this level of strength, it's telling me that we are in for some big surprises over the next couple of weeks in regards to Tesla's earnings on July 23rd and in regards to the robotaxi event on August 8th. And if you have been a viewer of this channel for the last week or so, you would know I think Tesla stock is going to all-time highs by October. During this same period of time, we may actually get a correction in the markets, meaning that I think Tesla can do well even if we do get a correction in our markets, because I think it's going to be more of a rotational correction where you get a sell-off of big tech, of stocks with elevated expectations, and you can get that money moving into other areas of the markets with a stock like Tesla still down about 40% from all-time highs, showing the level of strength that you have seen in recent days. I would argue big money is looking at Tesla in a different light than they were previously. They're looking at Tesla from the standpoint of how much can Tesla run here? Is Tesla getting better and the fundamentals improving? And the answer is yes. And how are Tesla's AI prospects looking? And after August 8th, we're gonna have some pretty exciting things to look forward to. But then again, Tesla's RSI is at 87.2, which is the most overbought you have been since back here when Tesla stock hit about $300 per share. Keep in mind what happened during this period of time. I think this is what could be almost an exact replica of what we could get this time around for Tesla. Back here between June 20th and June 21st for Tesla, Tesla peaked out at about $275 per share. The RSI was at about 88 and a half, even more extended than where we are today. What happened is Tesla ended up falling about 13% down to about $240 per share, and that reset the RSI back down to about 57 or so. And then what happened? Tesla rallied from 240 up to 300. That was a 25% rally, hitting a new cycle high during this rally, and the RSI only ever got to about 72. I think we could see something like this again, where you do get a pullback and then the stock can really start to work and see an even larger rally and totally reset the RSI, where, you know, a lot of people that are shorting Tesla, that's what they're looking at. They're saying Tesla's RSI is overextended, we should short Tesla. But that's not a reason to short a stock. That's not a good reason to short a stock, because yes, does that mean you get a short-term pullback most of the time? Yes. But then you tend to rally right back again, especially if there's a sound fundamental reason why the rally is happening in the first place. And I believe that is what we're currently seeing. So don't be surprised if Tesla takes a little bit of a move down. Maybe if we get the correction, maybe that's the reason for it. Maybe it's just a little bit of a sell down after Tesla earnings. Who knows exactly what the reasoning is? But then I would expect Tesla to pretty sharply, like you seen back in mid 2023, to retake a new high and continue much higher at that point. And I'm not going to change my call for new all-time highs by October. The only thing that would really derail that is the Fed, the path forward for the Fed. If the markets start to not like what the Fed is doing, that could obviously impact Tesla to some degree, and the economy. If the economy looks like it's getting too weak, if the Fed cuts into weakness and it looks like we're going into recession, that could be problematic. Also worth considering, we're expecting the first cut by the Fed in September. And normally the S&P sells off about 23% on average following the first Fed rate cut if the Fed is cutting into weakness. I doubt the economy gets any stronger from now until September. So if the Fed is cutting in September, they're going to be cutting into weakness. And historically speaking, that would mean a larger downside move for markets. I personally think the Fed's going to try to wait until November 7th to cut rates, just to remain, or appear to remain, as politically neutral as possible. There's a lot of calls right now to just incorporate the Fed into the government because they're very political anyways, which history would suggest they kind of are. They don't like to cut during an election year at all. But, you know, they have before, like 2008, they were cutting rates during an election year, but they were forced to cut rates because the economy went to crap. So personally, I think the Fed's not really going to be too interested in cutting rates in September, so we'll have to wait and see. That could actually prolong the period in time before we do get a larger pullback in markets. Believe it or not, if we get a cut in September, I think that pushes up the crash per se to probably second half of August, if not September itself. If we get a cut in November, potentially that crash could be October or so. But there will still likely be a crash when the Fed cuts rates for the first time. Unless the economy somehow magically strengthens from here and inflation continues to fall, which does look unlikely. Even to that political point that I was just making, Senator Tim Scott, Republican, that just went on CNBC, he says, Fed Jerome Powell's testimony, a rate cut in September, looks pretty political. So again, odds are that's probably not going to happen in my personal opinion. Now, I do want to share this clip with you that says markets need a correction, but not necessarily one worth 20%.
Also, that we're on the way to some type of correction coming up, possibly double digits. We've had other people say similar comments that just because of this concentration, that there's a lot of volatility that could be coming up for the markets.
Right. I do agree that there needs to be some sort of shift, that it's very likely to have some sort of shift. I don't know if we necessarily have to have a full-on 20-cent per correction, but certainly some type of downturn and definitely some type of rotation And that means a bit of a pullback from these leaders that we've seen, and maybe some performance that we can hope from some of our value or smaller cap stocks, even within the S&P 500. So I think, we've been calling for this type of rotation or this type of correction for quite some time, because the warning signals have been there for so long. And it's just really a matter of perhaps when and not if at this point when looking at the backdrop.
Aaron, it's interesting that you're talking about warning signals. Strategist out with the note yesterday that I was reading. I was bouncing off a bunch of people. I want to get your take on it as well. They say in part, the gap between the performance of the market cap and equally weighted index, talking about the S&P, has only been this wide in two other cycles, the late 90s and the late teens. Reversals from such wide gaps are often severe and rapid. It sounds like you were saying something similar, that the rotation is going to be pretty dramatic when it finally comes.
Right, exactly. And we see that whether you're looking at equal weighted versus weighted cap, or you can see some similar sort of extreme readings when you're talking about breadth or small caps. It really is a question of when investors either lose their appetite for those leaders, those mega caps, or finally are willing to take on a little risk and invest in some of the stocks that have been so ignored for the past year. And unfortunately, we've been wrong a few times in the past few years, and people are a little hesitant to jump because, like I said, the warning signals are there. But we really haven't seen the appetite for investors to shift into different types of stocks or different types of asset classes within the market caps.
We'll have to wait and see on that rotation. But I also want to focus on how you're seeing today shaping up. What's your WEX word of the day?
My WEX word of the day is disconnect. And that's really, what we've been talking about. Where there are just all of these warning signals, but the market isn't following through. I think for anything that happens to do with interest rates could trigger that rotation, as well as any big changes in expectations when it comes to economics, which might be further down the week and through earnings season.
And also this clip that says markets are due for a correction, but investors should buy the dip.
What Jim Cramer had to say, agree with him that we're just too worried about all this concentration, and really we need to focus on innovation and look for companies that can get to those $2 trillion, $3 trillion marks instead of worrying about the ones that are already there being too much of the market gains so far this year?
I would slightly disagree, Frank. I do think there's concern with this concentration. Look, we've got a 40-year high in these top 10 mega cap stocks in terms of their concentration in the S&P 500. And for sure, they are ripe for correction. I agree with Wilson's comments as well. I think the difference is that would be a buyable dip. I think this innovation is real. I think artificial intelligence is going to continue to change our world. But for sure, we should see some broadening out in the other 490 in terms of their participation moving forward.
All right, so you're echoing the sentiments of Mike Wilson, who we just talked about a short time ago. We've also had Piper Sandler come on and say they're expecting a dip of as much as 10%. So a lot of people worried about that. In fact, I want to ask you about something else. Strategist out with the note yesterday, saying in part, talking about the market concentration though, saying in part, the gap between the performance of the market cap and equally weighted index, talking about the S&P, has only been this wide in two other cycles, the late 90s and the late teens. Reversals from such wide gaps are often severe and rapid. So you're saying you'd buy the dip, but are you worried just about the volatility if we do see this reversal that Strategist is worried about?
I expect volatility is going to be par for the course here, Frank, over the traditionally choppy August, September timeframe leading up to the election. But step back and look, fundamentals of the U.S. economy are still good. The employment market is softening, but people are still very comfortable with their jobs. Look at consumer spending. People are still out in hotels and restaurants. The underpinnings of the economy are sound, and we still expect second quarter earnings growth year over year to be up 8 or 9%. So I think it's premature to be overly bearish.
All right. So you're looking at earnings, and I know you're also looking at valuation. So you sent us some research from your team. According to your research, the Mag 7's trading at about 47 times forward earnings, so kind of high valuation. But the S&P 490, if you subtract the top 10 stocks in the index, they're actually trading at 17 times. So as we look at that, and that S&P 490, which is a much, much, much more favorable valuation, where are you seeing the opportunities? Are there certain sectors? Are there certain stocks?
We do see opportunities there, Frank. Couple reasons. So number one, we believe the Fed is going to start lowering rates in that September timeframe due to some of the slowdowns that your other guests have noted. And I think you're going to see investors looking for yield, looking for alternatives to cash. So those S&P 490 companies, the dividend yield is close to 2%, and the valuation is trading at 17 times earnings. So we think there's much greater upside if there's a focus shift in the market from this high beta growth environment, but in a declining rate environment, the cost of capital becomes lower. We think there's a shift more towards these value dividend growers, not just dividend payers, but companies that can grow their earnings and dividends.
Okay, but are those REITs? I mean, what are you talking about? Like, what area should we look for? Because the 490 is obviously a very diverse group of stocks.
Yeah. So I think outside of technology, healthcare, consumer staples, financials, all of these companies should benefit as the Fed begins to lower interest rates and we see cash moving off the sidelines to seek these higher dividend yields.
All right, so Greg, one last question. You believe that if there's a correction, that's a buy the dip opportunity, but at the same time, you're really bullish on bonds, specifically municipal bonds. I want to ask, why would you have your money tied up in bonds if you think there's going to be a dip and that the innovation story is very real? I know you're in favor of a municipal bond ladder, yield 3.5%, equivalent to a taxable yield of about 6%. But again, why be tied up in bonds right now if you think there's going to be a viable dip and the innovation is going to continue to push the markets higher?
It's about allocation, Frank. You definitely want to be locking in these high quality muni yields now because we don't think they'll be available in 6 or 9 months. As the Fed begins to lower rates, I think you're going to continue to see the yield curve start steepen. I think you're going to see short-term treasuries yields drop, and investors who are used to getting 5% in these money market funds, when the Fed fund rate starts to drop, are not going to be able to reach that. So locking in today these high-quality muni yields, and if tax rates change next year, which we expect that they may, that's going to make the demand for these munis and the demand for that tax-free yield even greater.
And finally, Morgan Stanley's Mike Wilson says a 10% correction is highly likely.
How much can these companies start to deliver here? How much of an issue are they going to have if they don't?
Well, I think this is one area where, once again, bad is bad. Okay, so I would argue that, weaker economic data is potentially good for multiples generally, at least if you're delivering on the earnings. But if you have bad earnings reports, you're going to get punished. And that's been consistent all year, which is why the average stock is down this year. The average company has not had good earnings results.
That's a good point to make, Mike, by the way, because we talk about, Jess Menton from our equities team writes about this earnings expansion that we're in, 3 quarters in a row of growth, but it's only 7, 8, maybe 10 companies. The other 490 in the S&P are not doing well. So what has to happen for them to grow, to increase their earnings, to do well?
Yeah, well, first of all, it's more than 7 companies, but it's not more than probably 30 or 40. So it's narrow. It's like a nifty 50 almost is what I would characterize it. Now, what needs to happen? Once again, we need the Fed to cut meaningfully. We need the curve to re-steepen. We need cost of capital to come down. We need the labor markets to loosen up in a way where, these smaller businesses can actually hire people at a reasonable price. They need pricing power to come back. One thing that gets overlooked is companies are losing pricing power now. So while we're all rooting for lower inflation, once again, weaker inflation is not great for earnings. Small cap businesses, small cap companies like Russell 2000 typically only does well coming out of a recession, coming out of a new cycle. Why? Because rates are low, curve is fully steepened, access to capital is abundant, and they have operating leverage again. That's just not where we are. So we need rates to come down as number one, or we need some sort of exogenous positive shock on the growth side that doesn't lead to an inflationary problem. So you tell me where that's coming from. I think it's going to be it's a challenge, and that's why we're not going to fight this trend. I mean, the momentum is so strong because it's right. Now, what worries me is that momentum is so strong, and people have a lot more exposure to high multiple stocks than they think they do. And if you have an event that's unpredictable, then you could have a real reset on valuation of 10, 15%. Like, I think the chance of a 10% correction is highly likely sometime between now and the election. Not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So yeah, I think the third quarter typically is that period, and it's going to be choppy. Now, we're hoping that's going to create some opportunity, but like right here, valuations to me look very, very unexciting.
Morgan Stanley strategist also noted that while the level of participation in the S&P 500's advance this year has been historically low, data suggests that this doesn't necessarily mean stocks are headed for a bust up. Instead, history shows the chances that the rest of the market rallies to catch up with the mega cap stocks are roughly equal to the possibility that the mega caps give out, taking the indexes down with them. He also goes on to say, while the strategy has generally worked, investors eventually will be forced to reckon with the possibility that the good news or bad news is good news economic dynamic that has recently helped to prop up stocks could ultimately come back to bite them. And again, at this point, in my personal opinion, all you really need to see to get a 10% pullback would be earnings estimates that prove to be too high and start to come down. It really wouldn't take much. Let alone AI, I think, is a little bit of a problem. I do strongly believe 10 years from now, AI will be a deeply embedded part of our lives, from cars to phones to brain chips to everything else. I mean, we can't even imagine all of the use cases for AI right now, but for the markets to expect all of these AI returns from investments, right? Return on investment, ROI, in the next quarter or two as we are, doesn't make a whole lot of sense to me. You're not going to see much of any return on investment from the AI spend from your hyperscalers. And it might turn from, AI euphoria to AI disappointment, as strategists said in a note just a couple of days ago. I think that's also what could be problematic. You mix that with lower than expected earnings estimates, and you're looking at a much steeper fall, let alone the recessionary potential problems that could come out. If you were to theoretically mix all of these things together, you could see a 30-40+% fall from here. Now, is that a base case assumption? Absolutely not, but it's not that far out of the realm of possibilities as well. And at the bare minimum, as an investor, for you or your family or for just you and your wife, whoever it is, you need to be prepared and ready and subconsciously know that that is a possibility. But I do think good news is, if you are allocated to Tesla, I think Tesla's still going to do well here regardless until the economy does enter a recession. Because again, let's be honest, with all of those three pillars, those were the three pillars, by the way. It is the economy, it is AI, it is the Fed, it is earnings. I guess four, if you will. Tesla's things are going to get better for Tesla, especially as rates fall, until there is a recession. The next move from the Fed is cuts, so that's still positive for Tesla. And in regards to AI, as a lot of your, let's say, hyperscalers like Microsoft and Google and Apple, their AI results are going to be in the millions of dollars of ranges, right? They're bringing in hundreds of billions of dollars a year in total revenue. It's going to be marginal at that. It's going to be less than 1% of total revenue. That's not that impressive. But Tesla, on the other hand, is going to be bringing in and is bringing in billions of dollars a year from AI today. So if you were an investor that wanted to look at companies that are bringing in high dollar amounts from AI, Tesla is the top of that list. So I think even in regards to the AI argument, there's not much of that for Tesla, right? There's not much of the argument that AI is years away for Tesla, right? It's happening today. And especially after the robotaxi event, I think there could actually be a push of capital into Tesla, especially as maybe Microsoft, Google, Amazon, Microsoft, these other stocks are going to take a lot longer to realize the AI prospects of their AI investments, whereas Tesla, again, is already seeing those returns. So I know all of these things get a little complicated, but long story short, be prepared for a correction just in the event earnings come in as a slight disappointment, as there is a little bit of a reject to the current earnings expectations for next year, which I think is highly likely at this point. And you don't really need to worry about the big one, the big crash, until the Fed gets closer to start cutting rates, and until the Fed makes a mistake and pushes this economy into a recession, which they will do that. Or at the bare minimum, they will push us close enough to a recession where expectations will rise that we will see a recession, and that will have the same outcome on the markets in general, and that would be just a broad market sell-off. I think the question is, does that happen this year or is that a next year event? And I don't have the answer to that. But nonetheless, if you guys want to come potentially hedge out your portfolio, at the bare minimum, see what I am doing in my portfolio, which is, yes, hedging out my portfolio. Check out that link down below in the description of this video if you guys want to join the trading community. Nonetheless, that is going to do it for this one. Hit that like button and subscribe to the channel. Let me know what you think about this information down below in the comment section. Correction or no correction? I will also be running a poll here on YouTube, so go ahead and click on my little image there, go to the main page, the community tab, and vote on that. Do you think a correction is coming or not? You guys have a fantastic rest of your day, and I will see you in the next one.